Chapter 9 Technical Indicators and Oscillators. Welcome to Chapter 9 of Technical Analysis of the Financial Markets by John Morphy. In this chapter, we dive into the world of technical indicators and oscillators, the mathematical tools that help traders measure market momentum, overbought and oversold conditions, and possible reversals. What are indicators? Technical indicators are formulas based on price and volume data. They help confirm trends, detect reversals, and identify trading opportunities. There are two main types of indicators. Trend-following indicators show the direction and strength of a trend. Momentum oscillators show when the market is overbought or oversold. Trend-following indicators. Trend indicators smooth out price action to reveal the underlying direction. Examples include moving averages, MA, MACD, moving average convergence divergence, directional movement index, DMI. These tools work best in trending markets, not sideways ones. MACD. The MACD compares to moving averages, usually the 12-day EMA and 26-day EMA. When the short-term average crosses above the long-term, it's a buy signal. When it crosses below, it's a sell signal. The MACD histogram helps visualize momentum. The wider the bars, the stronger the move. Momentum oscillators. Momentum oscillators swing between two levels and help traders identify overbought and oversold conditions. Common examples are RSI, Relative Strength Index, Stochastic Oscillator Rate of Change, ROC, Commodity Channel Index, CCI. RSI, Relative Strength Index. Developed by J. Wells Wilder, RSI measures the speed and change of price movements. It ranges from 0 to 100. Above 70 is equal to overbought possible reversal downward. Below 30 is equal to oversold possible upward reversal. RSI is most effective in sideways or range-bound markets. Stochastic Oscillator. The stochastic oscillator, created by George Lane, compares a closing price to its price range over a certain period. It also ranges between 0 and 100. Above 80 is equal to overbought zone. Below 20 is equal to oversold zone. Crossovers between the %K and %D lines provide trading signals. Rate of change, ROC, and CCI. The rate of change indicator measures the percentage change between today's price and that of several days ago. It reflects the speed of price change. The Commodity Channel Index, CCI, measures how far prices have moved from their statistical average. High values suggest overbought conditions. Combining indicators. No single indicator is perfect. Professional traders combine trend indicators, like moving averages, with momentum oscillators, like RSI or MACD, for confirmation. This dual confirmation approach reduces false signals. Divergences, a key warning signal. Divergence occurs when price makes a new high, but an oscillator fails to do so, indicating a possible reversal. Bullish divergence, price makes lower lows, oscillator makes higher lows, potential rally. Bearish divergence, price makes higher highs, oscillator makes lower highs, possible decline. Guidelines for using indicators. Indicators confirm price trends, they don't predict. Always use multiple time frames. Combine volume data with momentum signals. Avoid overloading your chart, keep it simple. Chapter 9 teaches us that indicators and oscillators are supporting tools, not standalone systems. They help traders see what raw prices might hide, momentum, strength, and emotional extremes in the market. Used wisely, they sharpen timing and reduce risk. In short, indicators don't tell you what will happen, they help you understand what is happening. Here's a summary of Chapter 10 from The Technical Analysis of the Financial Markets by John J. Morphy. This lesson focuses on moving averages, MA, one of the most practical and widely used tools in technical analysis. Welcome to Chapter 10. In this lesson, we explore moving averages, a simple yet powerful way to identify trends and smooth out market noise. What is a moving average? A moving average is the average price of a security over a specific period of time. It helps traders focus on the trend by filtering out day-to-day price fluctuations. Think of it as a trend line that moves as new prices are added and old ones drop off. Types of moving averages. There are two main types of moving averages. Simple moving average, SMA, adds up prices over a period and divides by the number of periods. Example, a 10-day SMA is equal to sum of last 10 days prices divided by 10. Exponential moving average, EMA, gives more weight to recent prices, reacting faster to market changes. Traders often use EMA for short-term signals and SMA for long-term trends. Purpose of moving averages. Moving averages help with three key things. Trend identification. Is the market trending up, down, or sideways? Support and resistance. The average often acts as a dynamic support or resistance line. Signal generation. Crossovers and slope changes generate buy sell signals. The crossover technique. Crossovers are one of the most common trading signals. When a short-term moving average, like 50-day, crosses above a long-term moving average, like 200-day, it's called a golden cross bullish signal. When the short-term average crosses below the long-term, it's a death cross bearish signal. These signals show when momentum is shifting in the market. Using multiple moving averages. Traders often use 2 or 3 moving averages together to confirm trends. For example, 10-day EMA, short-term, 50-day SMA, medium-term, 200-day SMA, long-term. When all are aligned upward, it confirms a strong uptrend. When all slope downward, it confirms a strong downtrend. Moving averages as support and resistance. In trending markets, prices often pull back to touch the moving average before continuing. In an uptrend, the EMA acts as support. In a downtrend, it becomes resistance. Traders watch these bounces closely for entry points. Limitations of moving averages. Moving averages work best in trending markets, not sideways ones. In choppy conditions, they produce false signals or whipsaws. That's why traders combine MAs with other tools like volume, RSI, or MACD for confirmation. Weighted and smooth averages. Beyond SMA and EMA, there are other types too. Weighted moving average, WMA, assigns different weights to each data point. Smooth moving average removes even more volatility for long-term trend studies. These variations help fine-tune sensitivity based on trading style. Time period selection. Commonly used periods include short-term 10-day, 20-day, for swing trading, medium-term 50-day, for position trading, long-term 100-day, 200-day, for trend following. The longer the period, the smoother the line, the slower it reacts. Combining with oscillators. A smart trader combines moving averages with momentum indicators. Example. When a golden cross forms and RSI moves above 50, the trend is strong. If RSI disagrees, it's a warning to be cautious. Moving averages are the foundation of trend analysis. They tell us where the market has been and help us see where it might go next. Used wisely, they simplify complex price data into clear, actionable insights. The trend is your friend until it bends at the end. And moving averages are your best guide to follow that trend. Thank you, friends. If you like this summary, please like and subscribe this channel.